Good morning, ladies and gents, and welcome to the May 2025 edition of the Blackfinch 10-minute market forecast. Hope you're doing well and you're feeling refreshed after the bank holiday. My name is Jordan Kent, Strategic Business Development Manager for Blackfinch Asset Management. I'm joined today by Mr. Josh Clayton, Listed Product Specialist. If you have any questions throughout the webinar, be our guest and make note in the Q&A box at the bottom of your screens. We'll make sure to come back to you once today's webinar has finished, or you can wait until the end of the webinar where I'll provide you with details to reach Josh and I directly. Before we begin, it's important to note that the content covered today is intended for financial professionals only, such as yourselves, and should not be interpreted as financial advice. We have two key themes for you today. First is whether Liberation Day has placed further pressure on US exceptionalism. We've seen markets showing signs of stabilization since Liberation Day on April 2nd, with the S&P 500 regaining lost ground and tech giants like Microsoft and Meta reporting strong earnings. We'll explore whether we're starting to see a broader retreat from the idea of US exceptionalism and how much this is being driven by shifting capital flows, tariff expectations, and a changing global investment landscape. Second is what impacts there have been on the US economy and whether there's more to come. Despite the market rally, recent GDP figures reveal a contraction in US economic growth, the first in 3 years. We'll explore what's really going on beneath the surface and question whether we're simply looking at a temporary distortion or if these are early signs of a more structural shift in the economy. And so with that, I'll hand over to Josh to get into the detail of these subjects. Morning, Josh.
Good morning, everyone, and thank you, Jordan. So we're over a month on from that famous Liberation Day on the 2nd of April, and there's definitely a lot to unpack in that short space of time. So if we're looking at the headline level, it looks as though markets have begun to settle down and make back some of the sharp losses that we saw at the start of last month. And the measures of risk appetite and the perceived risk in credit markets are both almost back to where they were before President Donald Trump began his presentation in the Rose Garden. And the S&P 500 has made its way back to original levels, and we're showing some signs of growth again. And this is kind of what the chart is showing here. So I've taken the chart from our Bloomberg terminal, which essentially reviews the performance of the US stock market, represented by the S&P 500 in black, against the rest of the world in blue, where the FTSE All-World Index completely excludes the US. So this is certainly good news for some investors that could be nursing some heavy losses from holding the likes of the Mag 7 or just a broader index. But that said, the general consensus post the 2nd of April is that tariffs will inflict more pain on the US than on the countries being tariffed themselves. The rally's been more pronounced in other developed countries, and even though it looks like US equities are coming back, the retreat from US exceptionalism continues. As an aside, there are still some winners going on amongst all the noise. We had both Microsoft and Meta report earnings, with the key points being they're still growing revenues and claimed AI was improving profitability. So the longer term structural investment theme on AI integration is absolutely still going on under the hood, but it may mean more active management is of use here, where your stock pickers can really understand potential AI and tariff impacts. But Blackfinch, we made trades in our MPS portfolio shortly after Liberation Day in light of the volatility, where we decreased our US allocation and participated more in the upside for that blue line in the chart there, meaning a higher allocation to the likes of Europe, who are benefiting from a fiscal regime change. But what I thought was really interesting over the month was that even though the US stock market was staging a rally, driven by some good earnings and I guess less political noise, there is a lot of growing evidence that the US economy is somewhat faltering. Last week brought the news that the first estimate of GDP for the quarter ended March declined 0.3%, and that's only the second quarterly fall since the pandemic and the first in 3 years. And this is what's shown in the chart. So if we just dig into the underlying data for this GDP figure, and if you remember your textbooks from your studying days, I think it would be RO2, you had a simple formula for calculating GDP, and that was your consumption plus your investment plus your government spending, and then less plus your net exports. So you're gonna get your exports and less imports from that. And that formula It's really important because if you look at each underlying component, it's in fact the US's imports, which is absolutely massive. And then if net exports is negative as a result, it's going to detract from the other components. And that speaks to the contraction in GDP here. Essentially, businesses were ramping up their imports to get ahead of these tariffs. And you would have seen a lot in the press about the term front loading. So these businesses are just overstocking on materials as it's cheaper for them to do it now and hold on to the materials rather than wait for the tariff hit and buy then. So there's some argument to say this is a one-off figure to have such a sharp change in trend, and all eyes are going to be on the following quarterly figure to see how much the US economy can grow by. If we are seeing falling figures, this brings back concerns over a possible US recession. We could see a further leg down in valuations, but really the magic date for us to look out for is the 8th of July, as that's hypothetically going to be the end of the 90-day pause on tariffs, and this could cause some volatility for markets. But one other theory just for us to explore here, and this was something we were discussing in our analyst meeting last week, is hard versus soft economic data. Now, this GDP figure is what's known as hard economic data, and that's essentially objective, quantifiable indicators that have already happened and are from some actual economic activity. So in theory, this is kind of like backward looking, right? So it's already happened, but soft economic data are surveys, sentiment indices, and they talk to the expectations of economy. So for the moment, for the likes of your headline, for your core inflation, so hard inflation data, they're still declining and they're in a declining trend toward target. And it feels like the kind of Fed has it under control. But then the soft survey data says differently. You take your purchasing manager indices or your PMIs, for example. These surveys are going to ask the likes of your services and manufacturing businesses and physically ask, are you seeing higher prices or lower prices? And if you look at the manufacturing sector in particular, there is a strong upward trend reporting that prices are rising, but it's just not coming through in the hard data just yet. So the longer we wait, or actually the longer Trump waits with the likes of his 145% tariffs on China, the longer the soft data potentially hits the hard. And on that, we saw an example with two companies, Temu and Shein, who I'm sure you've maybe bought something from them, but they're big manufacturing exporters in cheap goods and clothing. And I think Shein is almost like the answer for Boohoo in China. But Temu are nearly passing all costs on to the consumers, and Shein are raising prices by 377%. So I think the longer the Trump waits, the longer you'd expect some form of price rises to feed through into the hard data. And if tariffs continue and cause a headache, we could get some form of supply side or inflationary driven shock for the economy, a bit like what we saw with the onset of the pandemic, but for very different reasons. Back then, we had a supply shock and then a massive demand impulse from fiscal and monetary stimulus, but we don't have that this time. But there are some parallels, and it is almost this near-term supply-driven inflation shock that can impact your figures. If you just look at forecasts for inflation in the US for this year, Bloomberg indicators are showing an uptick from roughly 3% to 3.2%. So economists are now starting to forecast price rises for 2025 too. However, there's an argument to be made that it may be a different story to what we saw in 2022. So I thought this was quite interesting. This is basically the tonnage of goods coming from China to the US. I don't need to point out what's happened here, but essentially it's a collapse. It's dropped from positive growth in monthly container imports versus 2024 to strongly negative, and then forecasted to remain on that trend. And interestingly, I saw an FT article that said businesses are essentially just sat on their hands, hoping and waiting for to see if there was a trade deal that comes through between the US and China. And this here on the screen is actually the first bit of hard data coming through from businesses. So I was trying to sit here last week, trying to think about this, and I think it's worth just playing through in our heads. But let's say it roughly takes about 30 days to ship a container full of goods from China to the US. And we're already a month into Liberation Day. So we haven't seen the full impacts of this yet, but give it another month or so. We'll get the goods arrive into the port, but it will be far less than before. So that will be a sharp slowdown. That can have knock-on effects to the likes of the trucking sector. So this is going to slow down. There's less to transport. Maybe a few weeks after and into June, if there's nothing coming through and pauses and cancellations stay in place from these tariffs, then you're going to see empty shelves. If it carries on, then do we ask, will people potentially lose jobs? If there's less to stack on the shelves, there's less work. And that idea, in fact, feeds into more of a deflationary narrative over the medium term if these trends continue, because there's just going to be less demand overall. And this is why it's different to COVID in 2022. There was so much, I think, pent-up demand and free money flowing from stimulus checks and schemes. A lot of it just went straight on goods, and that spiked inflation. But this time around, that isn't the case. But the problem is we don't know how this will play through, if that narrative does play through. And it's essentially up to Trump and his trading team. I've certainly had a go at discussing these ideas on the webinars, and things can change so quickly. And this is why it's so uncertain. And this is why there's almost a question mark over the direction of travel for inflation. So just to wrap up, I've covered a lot here on this webinar. So what does it all mean? I guess if we just do 3 takeaways, one, there still remains a lot of uncertainty around the US. Trading volumes and growing data potentially points to this further slowdown in US exceptionalism. And we'll place caveats on that pending political actions, but this does imply continued volatility in the US. And as I've mentioned in previous webinars, we can mitigate, we can diversify through a multi-asset portfolio. The likes of your active management can really kind of help identify well-capitalized and compelling businesses. And a use of an equal weight US fund can help smooth return profiles. And on the US for point 2, it certainly looks like the US isn't the only game in town now. Amid all of this volatility in markets, if you were well diversified, you've really done well in terms of returns. And you can do that in many ways. You can do it at the regional level with more domestic themes and emerging markets, European funds, and as well as across asset classes. And I think what this drawdown has taught us is that the role of bonds are firmly back in a portfolio. They've performed as expected amongst all of this volatility and growing recessionary fears, and provided some good diversification. And also there's a case for the neutral rate of interest potentially being above historic trends. And when I say neutral rate, I mean the natural longer term interest rate applied by central banks. And this means we can take advantage of higher coupons, and that feeds into a overall higher total return for a portfolio. And the third point is the 8th of July. I think this marks the end of the 90-day reciprocal tariff pause and will likely help us understand where the global economy could move next. Now, there's a lot of time between now and then. Unfortunately, a lot of space to make some political noise here. But in that time, a shameless plug for myself, Jordan, and the team here. We're absolutely on hand to discuss anything in person or over the phone, especially for times and like these. So we want to make sure we can help calm nerves. We're actively publishing documents on our website to help with this. So feel free to contact us or Mark, who's our head of distribution. But I won't steal your thunder, Jordan, so I'll pass you back for wrap up. So thank you, guys.
Very kindly, Josh. Thank everyone very much for taking the time to join us this morning. We really hope you found today's content useful. And as Josh has rightly said, if you have any questions on today's content, or perhaps something we didn't touch on, please do reach out to us using the details on screen now. The next webinar is due to take place on Tuesday, the 3rd of June at the same time of 8:50, where we hope you'll join us again. But for now, from everyone at Blackfinch, I hope you have a pleasant start to your week, and we look forward to speaking with you again soon. Bye for now.